So last year, JP, Jamaica Producers, and PanJam, you guys had your scheme of arrangements. Could you go through what that was for the viewers and also explain why you guys chose that method?
Well, we chose the method because we found ourselves with two big blocks of business activity, exactly what I just referenced. One being food and drink. And so the food and drink business kind of moved on from bananas, even though bananas were important. And so, obviously we still grow bananas in Jamaica and we still make banana chips in the Dominican Republic. But the largest, by far, revenue line of the group in terms of its food business was in Europe, where we were making fresh juices with factories in Spain, the Netherlands, and Belgium. And we're now in the bakery business with Tortuga, and we had bought into a water business in Santo Domingo and Punta Cana in the Dominican Republic. So there was the food business, and then there was the shipping business. And that business, we have obviously exposure to Kingston Wharves, where we're the controlling shareholder. It's a pretty substantial business. We also are a 50% shareholder in a shipping line, which runs 5 ships that go from the Netherlands, from Flushing in the Netherlands, to Portsmouth in England, and then down to the Eastern Caribbean, carrying consumer goods and vehicles. And then they bring bananas and mangoes and fresh produce back up from Colombia and the Dominican Republic. So they do a loop around, and we're in the freight forwarding business.
Is that is that Geest?
The Geest is the shipping line? Yeah.
Is it? Yes, sir. Okay.
And so we found ourselves in 2 blocks of businesses, which have certain risks. And PanJam found itself in 2 blocks of businesses: the property business, which you probably know, the Scotia Bank building, the PanJam building, Tourist Court building, Manor Park, things like that. Which include things that we actually operate in, like the Rock Hotel, which is the hotel business, and we're investors in the Courtyard Marriott. So they had a property business. I have a property business. And they also, when I say they, just to reference the time period, also had significant exposure to the financial services business with a 30% stake in Sagicor. And Sagicor, as you probably know, is very important to the economy. Largest life insurance company, largest health insurance company, largest pension fund manager, largest asset manager, strong position in commercial banking, in Cambio, in general insurance. So it's a very important part of it's actually the largest company by market value on the exchange. And so, but that had its certain category of risks as well. Or at least the property business and Sagicor had one category of risks, which were very Jamaica dependent. And the shipping business and the food business had its category of risks, which were almost entirely hard currency earning. And so what we decided to do was to pool them together and create one group with these 4 asset categories to de-risk the business. My own motivation was that I felt that they had generated a portfolio of non-core assets. So they were not just investing in what I would consider to be their main business lines, but they had built a portfolio of other things. And I wanted to, and still want to, and intend to, over time, divest that and do deals that double down on these 4 areas of specialization. So right now we have, depending on how you look at it and what day of the week it is, there's another 40 or 50 million US on the balance sheet not in cash or in repos, but in other types of securities that are not in those core 4 buckets. So what I think we can do is divest them and then do deals that build on those 4 areas. And I think that's going to really be useful to the shareholders. And it's something it's a model that we've more or less proven over the years at where we bought Geest and we bought Tortuga, we bought Hogastager, we bought into Kingston Wharves over the years, and that has led us to look back on our track record and see that we've been able to compound our on-balance sheet net worth after dividends by about 15% a year. And if you know exponentials, if you compound 15% a year for a long period of time, you can retire. So that's my goal.
Okay. Okay.
Sounds like a retirement stock indeed.
Well, I'm not there yet. So that's what we have to do. We have to take those non-core assets, and redeploy them in deals that are directly supportive of those 4 pillars. And once we invest in the 4 pillars, we have to invest in things that make each pillar stronger.
Okay. I can see that. Sense. And you spoke about the synergies, even taking it from just bananas. You said half the cost of a banana is really shipping. So why not just buy a shipping company? That's actually really brilliant. So yeah, no, I love it. I love it.